In this week's Property Insider chat, Dr. Andrew Wilson and I talk about the rental affordability crisis as we discuss what's happening to vacancy rates and rents around Australia, and we give you some insights into what's ahead. We also discuss the strength of Australia's economy, the latest inflation data, and what's ahead for interest rates, and what putting all this together means for our property markets. If you'd like to keep up to date with what's happening in real estate, please subscribe to this YouTube channel and click the little bell icon so we can keep you informed each time a new show comes out. We know that housing affordability is a real issue, with many Aussies now not being able to find their dream home, as 8 consecutive interest rate rises have cut many buyers' borrowing capacity by up to 20%. But what about rental affordability, with more and more people renting for longer at a time when the number of advertised dwellings for rent has plummeted, when vacancy rates are at record lows, and when rents have shot up at the fastest rate in a decade? What does this do to rental affordability, and how will this affect rental increases moving forward? That's what I plan to ask Dr. Andrew Wilson, Australia's leading independent housing economist and chief economist of My Housing Market, in this week's Property Insider chat. I also want to get his views on the strength of Australia's economy, the latest monthly inflation figures, and what's ahead for interest rates. Hi, Andrew.
Good day, Michael. Good to be back again. And we've had, again, some interesting data coming through during the week. And we did release our rent report. And as you said, it's sobering in terms of affordability. This is a real issue now in our community, is just how tough it is to be a tenant. And we certainly have a chronic undersupply of rental accommodation. The latest news was sobering for tenants, particularly those that are looking to rent a house. And of course, during the COVID era, we were looking for more room for home offices. Perhaps we're happier to live further away from the CBD as we weren't commuting as much. But the cost of renting a house and even a house on the fringe has certainly skyrocketed.
And as this chart shows, most capital cities reported significant rise in house rents over the year, Andrew.
Yes, and I think the monthly data is instructive, Michael. We saw 3 months in a row where house rents were flat. I think that perhaps we might have optimistically thought, well, supply and demand are starting to match. But what I think was occurring, and it goes towards your comments of affordability, was that rents had got to the point, house rents had got to the point where tenants just couldn't pay anymore. In other words, rents were rising faster than incomes. That's been a short-term relief for tenants, as we've seen house rents now rising again through November. Sydney up by 1.5%, Melbourne up 1%, Brisbane up 0.9%. And these are, quite heady increases in the marketplace, and something that is sobering for tenants. And I think that what we saw also during that period where house rents were flatter in early spring, that there were more choices being made towards units, which are typically more affordable than houses, by prospective tenants. And we continue to see surging rental increases in units, which we have seen consistently now for a number of months. I think that, again, that does reflect demand starting to move into that unit market away from the house market. When we look at the annual data, that really is sobering. We've seen the double-figure results for house rent increases over the year ending November. And for unit rents, we've seen increases even higher, particularly in Sydney and Melbourne, where rents for units are up by 25% over the year in Sydney and 23.3% over the year in Melbourne. And a lot of that, of course, is because of the absorption now of a lot of those vacancies for inner city units in Melbourne and Sydney. Combination of factors, of course, increased demand moving away from higher priced houses. We've also seen, with open borders, we're starting to see migration resume, student migration and permanent resident migration. They head for affordable destinations in terms of the rental market. And the other issue, which has been perhaps ignored in terms of moving away from the COVID restrictions, is that the Airbnb market, which moved into the permanent market as borders were closed, has now shifted back to the temporary accommodation market as borders are open. And that's taken supply away from some of those inner suburban, inner city unit rental markets in Melbourne and Sydney particularly.
Well, it's caused a lot of commentators to talk about ugly, greedy property investors raising rents because their mortgages have gone up, the cost of owning a property's gone up. But that's not really the case. The only real factor causing rising rents in my mind, Andrew, is the supply and demand equation, as you said, and I can't see that changing in the near future.
Well, absolutely, Michael. And landlords are small business owners. They have a considerable exposure to risk. They need to offset that risk. There are no guarantees that they will secure a tenant. They have to meet what the market is offering them, and what the market offers them has to be to make a profit substantial enough to offset all their costs. So there are no guarantees that that will happen. And this is, as you said, clearly just a product of an undersupplied housing market.
If you look back, Andrew, over the last decade, rents haven't kept pace with inflation. So it's not that landlords put up their rents when they want to. It really has to do with vacancy rates. And your charts clearly show vacancy rates are at historic lows. I don't ever remember vacancy rates with a zero in front of it, 0.6, 0.4, 0.8 in various states.
Yes, it's very sobering. It basically, shows that we've run out of rental properties, Michael. Even the Melbourne vacancy rate for units, which was as high as 6%, which at record levels, has now collapsed down at just 1.7% and falling rapidly month on month. And that goes to what we were discussing previously, that we're seeing less supply and increased demand in those inner city unit markets, particularly Melbourne and Sydney, which is seeing those vacancy rates now collapse. And of course, rents coming from a lower base are going through the roof. And of course, nothing was protecting the landlord to that degree when we did have the COVID experience and there weren't any tenants around. Some assistance measures, but certainly, again, that comes to the fact that landlords take the risk because it is an open market environment, and they have to take what the market is offering them. And there are no guarantees that they'll make a profit out of that. That's just the typical anti-landlord commentary that we tend to get for some strange reason. But I think that's a little bit of a left of centre view of the market. We're never going to be able to provide from the public purse the level of accommodation that's required in this country. That's a complete impossibility. We'd have to have, 70% tax rates to afford that. And we couldn't find the land anyway, really, in a public provision environment. We have to rely on the private sector, as we do in this country. We have a tremendous volume of small-scale landlords that do keep roofs over the head of a lot of Australians through tenancies, and rather than criticise them for being slumlords or whatever, we should support them. And I think that goes to what occurred 5 or 6 years ago when those questionable macroprudential policies were introduced by APRA that restricted investor activity, created a credit squeeze for investors, and really that only eased last year because investors were perceived to be the bad guys, the bad girls of the housing market. And now we're paying the price for those restrictive policies, very narrow-minded, in my opinion, restrictive policies that have been a contributor to what we're seeing now of skyrocketing rents, and many Australians now under significant financial stress as a consequence. And with inflation rising and interest rates rising, higher prices, higher mortgage costs, there's no real relief in sight, Michael, which is very sobering.
Well, some people are suggesting the new concept of build to rent, which has worked overseas, is going to relieve the rental stress here, Andrew. But I was interested to read on the weekend that Mirvac released a large complex in Melbourne near the Queen Victoria Market, and they proudly said the rents they were achieving in this large build-to-rent complex were 20% above the going rent in not build-to-rent complexes. So where's the relief for affordability there?
Well, businesses are there to make profits, and Mirvac is a very profitable, very successful Australian company. And they're obviously taking advantage of, as they should, what is a chronic shortage of rental accommodation. But of course, the whole purpose or the whole constructive build-to-rent is that it does need government support to make it work. It is basically a government private sector partnership to provide rental accommodation. The tax offsets that in particular that are required to make it work profitably for the private sector basically mean that coming out of the public's purse to support this. So in a sense, it's public housing by another mechanism. And look, that's fine, because we do need thousands of rental properties to balance the market out and to make accommodation more affordable. But as you said, Mirvac are doing what they should do and making a profit out of it, because they are now a large-scale landlord.
Yes. Now, another bit of news that came out over the week was the latest GDP figures. And despite the steep interest rate rises over the year, Aussies still seem to keep spending. And this consumer cash splash continued to drive robust economic growth. But is it really robust? What's happening to our economy?
I think there were some very interesting points that came out of the GDP, Michael, and also interesting from what we know is likely to happen. Now, of course, this is the September quarter, so we are looking backwards, and it does include what was occurring, obviously, in July and August, which is now pushing on towards 6 months ago. But the GDP growth eased from 0.9% to 0.6%, which was probably a little bit lower than the market was anticipating. If we use a rule of thumb, Michael, given that 0.6% down from 0.9%, we regard perhaps 0.75% as being a reasonably healthy quarterly result for GDP. That gives us a 3% annualised growth figure. And as I said, historically, that's regarded as being quite a healthy result for our economy. So at 0.6%, we're probably a little bit below the mark. If we look at the pre-COVID results for GDP, they were around about that between 0.6 to 0.8% per quarter. And as we know, the government, the RBA, was certainly unhappy with that level of growth, and that's why they were cutting rates through that pre-COVID period. But nonetheless, we still have strong household spending driving GDP. But we know that the latest October retail sales data was actually down. It was the first fall that we'd had since December. And no surprise, of course, with higher interest rates and higher prices really not keeping up with wages growth that we are starting to see. And this is what the Reserve Bank planned, of course, reduce spending. It's still very high spending, so it'll still make a contribution going forward, Michael, but it will be less. And of course, we will start to see more and more the impact of higher interest rates on consumer spending. And this is the RBA's plan, so there's nothing spectacular about that statement. As I said, I think it'll take away from what we've had during the September quarter in terms of growth, less household spending. Of course, the savings ratio also fell despite incomes rising. Certainly, we know that they're not rising at the same rate as prices are rising. So savings are still being tapped into to support households, but they're still at quite high levels, certainly higher than the pre-COVID position. The outlook certainly is for weakening GDP. That is what the RBA is planning, of course. The other thing that was interesting, Michael, from the September quarter data was the reduced impact of our trade position. We did see imports moving above exports, which took away from our GDP number. And also there was reduced impact from the income from exports of iron ore and coal, so which are, of course, big contributors to our economy, and which just is another sign of perhaps weakening demand in our international economy. So going forward, of course, we know there's speculation that the international economy will start to falter because of their interest rate policies, which will act to push down our export income, lower prices and lower volumes. And that will again impact GDP. We also saw an impact in terms of imports from and exports from increased travel, Michael, and certainly travel was up and about in terms of international travel and also interstate travel. But because of the level of international travel, that acted as an import, and that again took away from our trade balance, certainly took away from the GDP performance. And we're likely to see that continue. So future will be less impact from household spending, Michael, and certainly issues to do with what has been a very strong recent performance from our resources export sectors.
Well, when you dug into it a bit further, one can see that, in that, again, this was a couple of months ago, households continue to increase their discretionary spending as opposed to essential spending.
Yes.
They spent on hotels, cafes, restaurants, and buying cars. So, as you suggest now, with the interest rate increases and all the negative media, it's likely that we're not going to spend as much. I guess we're just going to have to see what happens over Christmas. A question on a lot of people's mind is what's ahead for interest rates, Andrew? The Reserve Bank in December once again delivered another rate hike.
Yep.
Is there going to be any relief in the new year?
Well, I think fairly predictably, Michael, the Reserve Bank did put up rates again. There was probably an outside chance that they could move into pause mode. They tended to have a little bit of an optimistic flavour in their minutes for the November meeting. What we can read from the governor's statement from the December meeting was perhaps a little bit more circumspect about the outlook, really giving nothing away, but certainly still reiterating that rates will continue to rise. I thought that comments in regard to the forecast for inflation were a little bit circumspect in the sense that the Reserve Bank is forecasting inflation to remain above 3%, a little above 3% in their words, over 2024. So acknowledging that the target is 2 to 3% for underlying inflation, it still gives us a couple of years with inflation being above the target range for the RBA's target range. So that sort of is something to consider in terms of how they're going to manage monetary policy to get it into that target range, not just over the coming months, but really over the coming years.
We're going to have a pause in January, and then in February they're going to have a couple of months data to see how their 8 interest rate rises have taken effect. So it'll be interesting to see what happens in February. Andrew, for many years, the Australian Bureau of Statistics has been recording and reporting the CPI, our inflation, on a quarterly basis, but more recently they've now looked at it monthly, but looking at a smaller basket of goods. We're still trying to work out how relevant this is, how well it's going to correlate to the quarterly figures, but the monthly data suggested a slight fall compared to September.
Yeah, it sort of worked its way in a similar sense to what we saw with the September quarter data, Michael. Monthly inflation down to 6.9%. I think it's interesting that we discussed this because the RBA actually mentioned it in their statement. So they are taking regard for that monthly inflation data. So we need to look at it on a monthly basis because it seems to be part of the analytical process for the RBA. But down to 6.9% over October, which was a lower result than the 7.3% that was recorded over September. No surprise that new dwellings are continuing to make a strong contribution to inflation. And that, of course, is all about the surging demand and the lack of supply to meet that from home builder last year. And, of course, that's meant that building costs have gone through the roof. Fuel also contributed to higher inflation rate and fruit and vegetables. But underlying inflation, we've mentioned that, was up by 3.5%, so down from the September result of 5.4%. And that September result, of course, I'm referring to is the monthly result. As I mentioned before, Michael, the target is 2.3%, but the Reserve Bank, and that's for underlying inflation, that's where they're heading towards with their interest rate policy. But they're still saying their current forecast is a little above 3% over 2024. So we've still got a bit of work to do to get to that level. The latest data in terms of those house building costs shows continuing to increase again over October. See how much higher they are now on that house building cost index from My Housing Market than they were prior to home builder last year. Annual growth of 17.2%, still quite sobering in terms of the cost of building a house, but lower than its peak earlier in the year of 24.6%. We look at the capital cities on an annual basis for the monthly data, which does tend to be quite volatile. We can see that Sydney's been the best performer over the year to October, and Perth the underperformer with house building costs up by 33.3%. And the relativity index, which shows the cost of building a house compared to other capital cities, shows Sydney, not surprisingly, the leader there. And those numbers generally reflect what we see in house prices as well, median house prices. And if we look at some of those other factors into inflation, this is the home rent index, which tracks weekly home rents and that's the trend for the quarter on those weekly home rents. And we can see after that period of pause that we did discuss, so this combines units and houses, Michael, as one measure, homes, but we're now starting to see that taking off again. And of course, that will work its way into inflation, because rents are part of that inflation basket. But the real good news, I suppose, is that we're still seeing a sharp decline in the international price of oil, which is now below $80 US a barrel, and maybe heading under $70 US a barrel on the current trend. So there's some good news there in terms of its impact on inflation, not just the cost, but also the impact it has on downstream price costs. So latest inflation data heading in the right direction, Michael, but still too high. And some of those factors which do contribute to inflation are still moving in the wrong direction, but some are improving, such as the price of oil.
Andrew, we had our second last auction weekend over the weekend, and the news this morning suggests that auction markets are falling and there's a sign of bad things to come. I guess they haven't watched the last couple of weeks' Property Insider videos where you explained that every year in December there are so many distractions that auction clearance rates always fall.
Well, we're certainly getting more and more of a whiff of desperation from the media in regard to the housing market and its outlooks, Michael. It's becoming a little cloud cuckoo land stuff at the moment. We always see lower clearance rates in December. November's usually the peak of the market in terms of the cyclical nature of housing markets. Of course, buyers and sellers are distracted moving into December, particularly buyers. We tend to get higher volumes of properties over the concluding weekends of the auction market. And so that puts downward pressure on clearance rates. Of course, the media has been telling us for months we were going to have a price collapse and it was doom and gloom for the foreseeable future. They've clearly got that completely wrong. We've seen a revival in our auction markets through spring compared to winter. And I think it's instructive, Michael, when we look at the big auction markets of Melbourne and Sydney, and we look back to 2018, which was a comparable time in terms of wavering confidence, fragile confidence in the market. We actually, as usual, had clearance rates easing as the year concluded, but clearance rates then were in the low 40s, Michael, not the mid-60s, the low to mid-60s, which we've consistently seen through the spring period too. But I think the markets are going to finish this year with one weekend left, quite satisfied that given the depth or the increase in interest rates, that housing markets have held up. Certainly the results are weaker than where they were, but coming out of a boom period, the consolidation has been a lot quicker and certainly less severe than many have predicted, Michael. And as I said, we had higher numbers at the weekend in terms of auctions, well below where they were a year ago, of course, because we were coming out of COVID a year ago. But nonetheless, the auction clearance rates during that boom period a year ago were falling from their peaks. So that seasonal impact which is occurring now. But, you know, the Sydney result was above where it was last weekend in the mid-60s. Melbourne result down a little bit, but Melbourne has eased over the last few weekends with higher auction numbers. But other markets were sort of roundabout where they've been over previous weeks. So I think actually, on balance, it was a reasonable result considering the typical cyclical easing of particularly buyer activity into December.
Well, I guess when we look back at 2022, we're going to see this is the year that inflation and rising interest rates dominated the headlines. It'll be interesting to see what's going to dominate the headlines next year, but we'll be back again next week for the last Property Insider chat for the year to have a look at what's happened over the year and maybe give a bit of a sneak peek of what's ahead for 2023, Andrew.
Yes, Michael, I think 2022 has been a year of surprises, and I think we're going to end off with surprises again. And the big surprise is that the housing market has clearly stood up.
Yes, that's definitely going to surprise some people who are just waiting for it to collapse. And overall, there's no doubt that certain markets have dropped in value, particularly the higher end Sydney and Melbourne markets have dropped close to 10%. But when those predictions of the overall Australian property market, we know there isn't really one of those, was going to collapse, that really hasn't occurred, has it? And interestingly, people look back at these chats, which are on the record and still there on YouTube. That's exactly what you said was going to happen. I think, in fact, the markets have stood up even a bit better You were wrong, Andrew. They're even stronger than you thought.
We've had a remarkable period of higher interest rates, Michael, but the whole point is that we're always into the unknown when it comes in terms of economics and human nature. And hasn't this year proved that?
Very much so. Look forward to our chat again next week, Andrew.
Thanks, Michael. Goodbye now.